As expected, the Fed raised interest rates by a margin of 75 basis points for the federal funds rates last night to 3.25%, a decision unanimously taken by Fed board members, as latest inflation data showing no improvement despite the Fed's efforts. FOMC statement reiterated the committee is strongly committed to returning inflation to its 2% objective. Powell told the reporters there, "We have got to get inflation behind us. I wish there was a painless way to do that. There isn't." Fed funds rate projection indicates a further 125 basis point increase by the end of the year. Now, during the press conference that followed the announcement, Fed Chairman Jerome Powell singled out a housing market as a persistent source of rising consumer inflation. What we need is supply and demand to get better aligned. We probably in the housing market have to go through a correction to get back to that place. Well, alongside the rate decision, the Fed published its latest economic projections and expects the economy to slow. No real surprises there. New projections see the economy growing by 0.2% in 2022, rising to 1.2% in 2023, currently at 3.7%. Unemployment is anticipated to rise to 3.8% this year and to 4.4% in 2023. As for inflation, new projections put it over a slow path back to 2% by 2025. One of the areas of the markets that have seen consistent gains is the dollar. This is the dollar basket chart. Yesterday, crashing through this line of resistance at 110.52, which was established by the intraday high we saw back on the 7th of September, that day when we saw inflation rise again, that core inflation. And this is the highest we've got here now in 2 decades for the US dollar. Let me just bring that up. You can see here the last time we were at these levels, June 2002, so more than 2-decade highs for the US dollar. The way to trade this is by looking at a euro dollar chart. Yesterday, we saw that line of support there broken at 98.64. This is now interesting because we've got an entire candle below that prior line of support now. That is now resistance. We're currently trading at 98.17. If you're short on this, your stop would still go around about the parity level with a view to taking this lower. I can't see any reason necessarily to buy this market in any way, shape or form. There may be a little bit of a retracement further on up, but you can see this pattern established here, and there's no real reason necessarily to stop that move. Ahead of the Bank of England interest rate decision today, new 35-year lows for sterling against that stronger US dollar. Just to quickly run around some of the other charts, we got the dollar pushing higher against the Japanese yen, a new 24-year high against the Japanese yen, and some of the other currencies that we've been following recently. This is against the Canadian dollar, very strong US dollar against that weaker Canadian. These are some of those currencies that are exposed to the commodity space. Another commodity currency, the Norwegian kroner. Today, we've got a break of this line of prior resistance at 103.560. US dollar now climbing there to levels not seen since the 30th of April 2020. So you can see the picture that's building for the US dollar in the wake of that interest rate decision from the Fed.